Central banks are the unseen forces driving the global economy. From setting interest rates to controlling the money supply, they play a vital role in ensuring financial stability. Welcome to the world of central banking, where every decision impacts the economy, your job, your savings, your spending power. In this video, we'll dive into the power of central banks, how they manage money, and their crucial role in the controlling inflation. Central banks are the institutions responsible for overseeing the monetary system of a nation or a group of nations. They're not like regular commercial banks. Their primary job isn't to make a profit, but to stabilize and manage the economy. In most countries, a central bank has the power to issue currency, control interest rates, and influence inflation, impacting everything from employment to global trade. One of the most crucial tools central banks control is the money supply. Think of money as the fuel that powers an economy. Too much money can lead to inflation, and too little can cause a recession. By regulating how much money is in circulation, central banks keep the economy from overheating or freezing up. When there's too much money, inflation rises. When there's too little, growth stalls, and people may lose their jobs. Another powerful tool is the interest rates. Central banks set the base interest rates, which influence borrowing costs for banks and ultimately for businesses and consumers. When central bank lowers interest rates, borrowing becomes cheaper, which can encourage spending and investments. On the other hand, raising interest rates can slow down overheating economy by making borrowing more expensive. The inflation is one of the central bank's biggest challenges. Inflation refers to this rising cost of goods and services, which reduces the purchasing power of your money. A little inflation is normal and even healthy for an economy, but when inflation spirals out of control, it can lead to economic instability. That's when central banks step in to prevent runaway inflation. Central banks walk a tightrope between controlling inflation and ensuring economic growth. If inflation gets too high, they may raise interest rates to cool the economy, but if the economy slows down too much, they may lower the rates to stimulate growth. This balancing act is essential because too often the central bank's decisions impact unemployment, wages, and even the value of your savings. While central banks manage their own country's economies, their decisions can ripple out, affecting global markets. Changes in US Federal Reserve policies, for instance, can influence the interest rates in Europe, Asia, and beyond. In a globalized world, central banks don't just control national economies, their policies influence the world's financial markets, affecting everything from stock prices to the cost of goods. As economies evolve, so too do the tools that central banks use. New technology, such as digital currencies and AI driven economic models, are changing the way central banks operate. Central banks are adapting to these changes, ensuring they remain effective in managing modern economies. From traditional monetary policy to exploring digital currencies, the future of central banks is full of exciting possibilities. Central banks may seem distant, but their decisions are at the heart of our daily economic experiences, shaping everything from your paycheck to the price of a loaf of bread. Understanding how central banks operate gives us an insight into the broader economy. Whether you're saving for retirement, buying a home, or investing, knowing the power of central banks can help you make more informed decisions.